Hey, welcome. Do you ever feel like you're just one step behind the market's big moves? Well, today we're diving deep into something called order block trading. It's an absolutely fascinating way to decode what the giant players are up to so we can maybe, just maybe, align our own trades with theirs. I bet this sounds familiar, right? You see the perfect setup, you jump in, and bam. Almost instantly the market whips against you, takes out your stop loss, and then, and this is the painful part, it turns right back around and goes in the direction you predicted. You're just left there scratching your head. It's one of the most maddening things in trading, and there's a reason it happens. But what if that could change? What if you could actually anticipate these moves? Imagine being able to spot the exact zones where the big institutions are likely to make their move and use that insight to your advantage. Well, that's exactly what we're going to break down right now. Okay, so to get a handle on this, we've got to talk about who's really pushing the price around. We're talking about what's called smart money. You know, the huge institutional players like banks and hedge funds. Their orders are so massive, they're the ones creating the trends you see on your charts. Now, here's the interesting part. They have a big problem. Their orders are so huge, they can't just click buy on $1 billion worth of currency. It would send the price skyrocketing against them. So they have to be sneaky. They accumulate or distribute their positions in these very specific zones. And this whole process, it's not invisible. It leaves behind a very distinct signature on the chart, kind of like footprints in the sand. And that footprint has a name. It's called an order block. Seriously, think of it as a launching pad. It's a specific price range where these institutions were busy stacking up their orders right before a huge market-moving explosion in price. The theory is, when price comes back to that zone, there are still orders left to be filled, which can trigger another powerful reaction. All right, so we get the what, but how in the world do we actually spot these footprints online? On a live chart, let's get into the anatomy of an order block. It's actually simpler than you might think, but the devil's in the details. It breaks down into two types. A bullish order block is simply the last down candle, right before a massive, impulsive move to the upside. That's the spot where smart money was soaking up all the selling pressure and flipping to buys. And on the flip side, a bearish order block is the last up candle just before a sharp drop. That's where they were selling off their positions before pushing the market down. Okay, here's the catch. If you go look at a chart right now, you'll see these last opposing candles all over the place. But here's the hard truth. Most of them are garbage. They're just random market noise. So the real question is, how do we tell the difference? How do we filter out all that noise and find the legitimate high probability footprints? This is where having a clear, rock-solid filtering system becomes your best friend. We need a set of rules, a checklist of non-negotiable criteria that a candle has to meet before we even think about calling it a valid order block. And here they are. These are the three non-negotiables that will help you filter out the junk. First, the move away from the candle has to be so strong that it causes a break of structure or boss. That just means it broke a recent swing, high or low, a real show of strength. Second, that powerful move has to leave behind an obvious price imbalance, something we call a fair value gap, or FVG. It literally looks like a gap on your chart, and it shows institutional urgency. And third, the block itself has to be unmitigated. That's just a fancy way of saying price hasn't come back and touched it yet. It has to be a fresh, untested zone. You see, when a potential order block checks all three of these boxes, the probability that it's a real zone of institutional interest just goes through the roof. These rules are your number one filter. They're what keep you from taking weak setups and help you focus only on the A+ opportunities. A+ opportunities. Okay, so now we know how to identify these high probability footprints. That's awesome. But let's build a practical plan, because let's be real, it's one thing to spot where the giants have been. It's a whole other thing to actually trade alongside them. Here's a super straightforward game plan. Step 1, use those 3 golden rules to find a valid high probability order block. Step 2, and this is huge, be patient. You have to wait for the price to come back to your zone. Don't chase it. Step 3, once price finally enters your zone, you drop down to a lower time frame and you look for some kind of confirmation signal, like another smaller break of structure. And then step 4, you execute the trade, but with a clearly defined stop loss right outside the block. Simple as that. And this right here brilliantly illustrates what separates a 5-star setup from, well, a mediocre one. A high probability block, as you can see, has that fair value gap and a really strong aggressive move away from it. But look, the most important factor is that it aligns with the higher time frame trend. Trading with the main current of the market is absolutely key. The low probability setups, they're usually trying to fight that trend. But please remember this, no matter how perfect a setup looks, risk management is everything. The pros don't just find good trades, they are masters at protecting their capital. A good rule of thumb is to never ever risk more than 1 to 2% of your entire account on any single trade. That's what keeps you in the game for the long haul. And, this really gets to the heart of the mindset you need. Trading with order blocks is not a crystal ball. It's a game of probabilities. We're using the evidence left behind on the chart to find an edge, a specific area where the odds are just a little more stacked in our favor. We don't need to win every trade. We just need a consistent edge that we can execute over and over again. So to wrap this all up, let's talk about where people go wrong with this stuff. Because honestly, knowing the common pitfalls is just as important as knowing the strategy itself. All right, here are the big ones. First, forcing trades. Seeing order blocks everywhere you look instead of just waiting patiently for those textbook A+ setups. Second, ignoring the bigger picture. An order block that's going against the major market trend is a low probability play, period. Third, impatience. Jumping the gun before the prices even return to your zone, or entering without waiting for a confirmation signal. And that leads to the last one, neglecting confirmation. Blindly hitting buy just because price touched a line on your chart is a recipe for disaster. So here's the bottom line. Learning to identify order blocks gives you this incredibly powerful lens to view the market through. It lets you see where institutional supply and demand might be hiding, but it is not a magic mechanical system. It's a skill. It takes pattern recognition, strict filtering, a whole lot of patience, and disciplined execution. So the footprints are there, they're on every chart, on every time frame, just waiting to be read. The only question is, are you ready to filter out the noise, stick to a disciplined plan, and start trading in sync with the market's biggest players? Thanks for tuning in.